right? 2022, you made a whole bunch of money. Unfortunately, now, April of 2023, you have an enormous tax bill. If you invest in an opportunity zone fund, then you don't owe your taxes in April of 2023. A tax deferral in an inflationary environment is a wonderful thing, but that's not the only OZ tax benefit. That's just the appetizer, not the entree. The really big opportunity zone tax benefit is the second one, which is, hey, you're going to use that money in your OZ fund to invest in something.
My name's Max Gagliardi, and this is Always Be Building. If you're watching this video, take a moment, hit the subscribe button on YouTube, or you can follow me on your favorite podcast app. Hope you enjoy the show. Barrett, welcome to the podcast. Thanks for coming on.
Yeah, thanks, Max. Good to talk to you, fellow OZ guy and oil and gas guy, and see where this conversation goes.
For sure. Well, you're just like this incredible educator on qualified opportunity zones, and you got a great presence on Twitter, and that's how I came across you. And we got into raising our first QOZ fund about a little over a year and a half, maybe a year and a half ago. And all during that time, the partners in the fund and the guys that we do real estate investment with were always like sending me threads. That's how I first came across you, is they'd be like sending me a thread that you did on OZ stuff. And so I started following you then. You've been very generous on giving advice. We've talked one other time, and just super generous with your time, and also generous with the education that you do on Twitter. But for those listeners that don't know who you are and your background, I want you to start there, and we'll take it from there.
Sure. Well, and first of all, it's really flattering when people share the stuff that I put out, and cool, but it's also very selfish, right? So I share this stuff, and then I get connected with really smart, interesting people who are doing cool things in the world, like you're doing in Broken Bow, and what other people are doing all over the country. And it's really the biggest reason that I've started sharing stuff on Twitter, is because I get connected with people who are doing awesome developments, and my Rolodex grows, so that when I want to learn about something like solar, like short-term rentals, or I don't know, wherever my brain leads me that day, then I can pick up the phone and say, oh yeah, I know Max, he's doing really cool short-term rental stuff. And I can call him and learn some weird nuance about that. So anyway, it's been a really neat learning experience for me, because I always have someone who's really in the weeds of some neat strategy at the tip of my fingers. So that's neat. But yeah, my short story is I've always been a real estate guy ever since I graduated college, almost always in the apartment business. So I started as a commercial mortgage broker. GFC happened, and I started making no money, overnight. Like the lending stopped, and I wasn't making any money. Sat down with a mentor of mine, and he said, well, you got two options. You can go start doing something else, or you can stick it out. You're not going to start making more money tomorrow. In fact, you'll probably make less tomorrow. But if you stay in the real estate business, when this thing ends, and it will end eventually, you're going to have more experience. You're going to have a bigger Rolodex, and you're going to be one of the few guys your age who did stick it out.
Right.
And those things ended up coming true. And so then in 2010 and 11 and 12, slowly, no money turned into a little money, turned into a little bit more money, and really understood the business and understood survival at the bottom of a cycle. And, so those things were good. I did my part-time MBA at SMU during that period. And then in 2012, I bought my first property. And so slowly started doing less mortgage brokerage and more property investing over the next 8 years, until eventually now I'm no longer a mortgage broker and kind of a full-time investor, and manage my own and other people's money in investments that we make in the apartment world, and now investing throughout Texas in the major markets, primarily in the opportunity zone tax structure. And also educating a lot of folks about that. And it's been an interesting ride.
Oh, that's awesome. The first thing I want to touch on is what you said earlier about the connectivity and meeting people and getting out there. And that's where I feel like Twitter has been awesome. I think if you use it in the right way, and I know people like to give crap to LinkedIn on Twitter, talk bad about LinkedIn, but it's also been another great network for me. They're different, but just meeting people and, putting yourself out there. And I think if you're adding, quality, adding something quality to the conversation like you do, that's huge because you're sharing knowledge, and then in return, you get goodwill back in these connections. It's also like with the podcast for me, why I just force myself to do it, because it's like it forces me to reach out to somebody new every week and to make that connection. So I see the power in it. I think some people don't get it. I feel like you definitely do get it. So it's really cool if you use the tools the right way. But the first thing I want to ask is, like, coming out of school and being right around there in that great financial crisis. I was graduated in 2009 and ended up getting an MBA very shortly thereafter, just because I was kind of in this weird spot where everything sucked. It was like the career fair was shut down, and I was just like, I don't know what I want to do. But what was talk a little bit more about what that was like, being in the industry during that time? Because for me, I wasn't in real estate, but I was looking to get into oil and gas because I had a background in that with some internships and just knew how hard it was. But just some color around what it was like then, and if you see any contrast from or comparisons from then to kind of the downturn we're in right now.
Yeah, it was extremely challenging. I went from 06, 07, and even early 08, where it was like making a lot of money for that age. I was 25, so
right,
making more than I needed for sure, to all of a sudden, and thinking the future looked very bright. So I went on full commission in the middle of 07 and thinking like, man, I'm going to crush it, to all of a sudden saying there's not a deal in sight. And so, yeah, it was very challenging, to the point where, all right, let's empty out my 401k. Let's go to mom and dad, in-laws. I wasn't married yet, but my future wife's family was giving her money. And, I think I wrecked my car. Like someone hit me, and my car was totaled, and the insurance company wrote me a check. And instead of buying a new car, I borrowed a car from a family member and bummed around in that and just used the money. It was like every dollar mattered a lot. And, very clearly remember that and what it took to get through. And it wasn't pretty. But then I also very clearly remember, like, that first commission check and how meaningful it was to say, like, all right, there's green shoots at the end of this. How much do I think that is similar today? I think it's pretty different. I think then it was like the whole world stopped pretty darn suddenly. Mm-hmm. I remember working on a loan then in early 2008, which was like going to be my first big commission check. It was a CVS, not an apartment deal, a CVS loan through a CMBS. And this guy was refinancing, and the loan terms, it was like the spread was 100 over the 10-year treasury. And then I called back 3 hours later to get the updated pricing, and it was like 150 over. Then the next morning it was 175 over. And then that afternoon it was 220 over. And it was like every hour the terms got worse until the guy told me, like, hey, I'm not doing this loan anymore. And it blew up. But it was within hours, the liquidity was gone from the market. This time feels different in that things are happening in slow motion. It feels like, all right, the folks who borrowed fixed rate over the last year or two, they're going to be okay. The folks who borrowed floating rate, I look at them as split. So some groups are very sophisticated. They understand their problems. They understand the tools available to them to fix those problems, and they're trying to use every single one of them. They're going to have some problem assets, and they're going to fix most of those problems. And some of them they might not, but in general, they're going to endure some pain, but get out on the other side okay. And then there's this other subset of groups that probably shouldn't have been a market participant in the first place.
Yeah.
They don't necessarily understand the problems that they're in. They don't necessarily understand all the tools available to fix the problems. And they're going to be in real trouble, and they're going to have pain and suffer the consequences of that pain. And so those two groups I view as very different. And it's all going to play out in slow motion over the next 18 months. There's no, it's not like they're going to call the desk every 2 hours and everything's changing in the next, in the next day or two, but it'll play out. And so that's what I think is so different versus 2008 and today.
Yeah. So was there no real writing on the wall? I mean, in 2008, you're saying it happened so fast. And it just seems like in retrospect, you'll see people talking about, oh, there was all these signs, in 06 and 07. But I mean, it's so hard in the moment to really know because you hear negative things, but then there's always this optimistic take. And then you're always looking back. I mean, everybody uses kind of historical as a proxy. So you look at a market and you're like, well, here's how the market's been. This is what it's been like. Yet it's hard to view like a sea change and really understand what that means. So you felt like in 08, it was just pretty like overnight, like things just changed effectively.
Yeah. I mean, look, people were legitimately shocked when Lehman and Bear Stearns went out of business. Right. There are guys, I mean, some of my buddies' dads and father-in-laws, very large hedge funds in Dallas who were actively buying the stock of Bear Stearns and Lehman Brothers when it was $1 and $2 because they were certain that these were going concerns that were going to be fine, right? And then the next day they went back, they're done.
Right.
And so I think what that tells you is that this was a total shock to the financial system that happened very suddenly. And, today it seems to be playing out in slow motion. And what that allows to happen is, like I said a minute ago, like these groups that understand what's coming, which is a lot of them, and understand the tools available to fix those problems they're not going to avoid the pain, but they might avoid some of the worst outcomes that less sophisticated groups are surely going to suffer.
Yeah. Well, it's interesting right now because I feel like anytime there's a consensus broadly, like in the markets, or everybody says, like right now, everyone's like, oh, we're going to have this recession and it's coming. And, anytime it seems like everybody has the same consensus, inevitably they're somehow wrong because it's like if everybody knew the outcome. And it feels weird right now because it seems like all these things are a foregone conclusion. But I don't know. It still feels oddly like we're not in a recession. I know things are slowing down. I know there's been tech layoffs, but you're based out of Dallas area, and I'm based out of Oklahoma City. The markets aren't the same, but Texas in general is a very strong market. Do you feel like some of this stuff is overblown, the doomsday predictors on Twitter? Is it somewhere in the middle? Is it very market specific, asset class specific? Because it feels like everybody wants to just paint a broad brush like the world's burning. But I feel like markets and asset classes matter more than people want to make it sound as nuanced as it really is.
Yeah, well, and I think that's social media is hard to have nuance, right? It's never been good for that. Right. And this is a case where nuance is important because if you say all commercial real estate's going to hell, it's incorrect. Fortunes are made even at the very bottom of the cycle by buying a great deal. And so I think that you just have to be careful whenever anyone gives a very broad statement boldly. Yeah.
Yeah. What do you think, before we kind of move into more of the specifics around the OZ stuff and what you do on the multifamily side, just people that are, you get on Twitter and it's like it seems like amateur people that are just getting into real estate. What advice would you give? I'll frame it two ways. What advice would you give to those people? Or another way to look at it is what advice would you give to yourself back when you were younger, given the information that you know now and the knowledge you have now?
Well, I think now there are more opportunities than ever to learn for free. And so you just have to be careful of who you learn from. But you can learn so much technical skill from YouTube.
Right.
from guys on LinkedIn and Twitter who will teach you for free and really are experts in their field. And so I would certainly take advantage of that. I can't tell you how much advice I've given out for free in, via DMs or email or whatever. Now, have guys use that information? I have no idea. But certainly I've given it out about opportunity zones and underwriting and other stuff. And I'm certain that like Moses Kagan's blog is just full of wonderful information. And somebody could truly learn how to be a pretty darn good apartment owner operator just by reading that. And so, yeah, I think that's number one. Number two, I think anyone who's getting into the industry and wants to do what I do, right? It kind of own, operate apartments and grow a shop where they're managing other people's money as well. I would start by either being a mortgage broker, by being a property broker, or by working at a shop like mine that's kind of doing it already. Because I think the greatest way to learn is just by doing a bunch of deals, seeing all the problems that pop up and seeing how they get solved. Because really the best way to learn is by doing.
Yeah. And it's tough in real estate because you want to do, but the stakes are high. And I am a pretty conservative person in general, although I do a lot of entrepreneurial things. So people think I'm like a big risk taker, but I feel that I'm conservative and I try to be that way in my finances and in my business dealings. But real estate, I've told people before that are interested in getting into it. The analogy that I've used is kind of like Game of Thrones. It's like you either win or you die. And I'm not trying to be dramatic, but when you have leverage involved, it's the stakes are high and people see a lot of success stories on Twitter or hear about, you listen to these podcasts, and I did it too early on when I was younger, thinking about getting into real estate, and there's a lot of risk involved. It's always going to be more complicated. When we have our partner calls, it's like, it's always something and we laugh because we're like, oh, it's always something. Like we knew that, insurance was going to increase unexpectedly or this thing was going to happen. I mean, we've had crazy things happen where it's like, we had a tornado that almost hit our development. It just missed us. And we're like, holy cow. And you can't insure against raw land really. And it would have just torn up all the trees and destroyed it. And it came like within a mile by us. We've had, builders get, builders and general contractors get like, rare diseases and be sick and not be able to, luckily that person's better. But there's just things that happen in real estate that you have to live through it and realize like, okay, there's a lot of stuff that can go wrong. And so for me, it's like, I don't know that people fully understand like the amount of variables that are out there and the risk that's involved.
Yeah. I mean, you've got to be a great problem solver because you're going to be solving a lot of problems. And I think by working in one of those roles, you learn, number one, all the different things, not all of them. You learn some, because I still find new ones every day. You learn a lot of the different problems that can pop up and how they're solved and how to think like a real estate person. And that gives you a huge leg up as you move forward and you figure out, is this what I want to be doing? Or is there some other role within the real estate world that's better suited for me? Because there's thousands of ways to make money in real estate. So, is this it for me? Or, would I much rather go to law school and be a transactional attorney? Or am I a really great salesman? And do I want to, be an insurance broker or stay in the mortgage brokerage or property brokerage world? There are really thousands of ways to do it. And man, there are so many people that make hundreds of thousands or millions of dollars a year doing a whole lot of different things. And you just got to figure out your niche.
Right. What was that step when you went and got your first property? Talk a little bit about it if you can, the first deal, or how you went about getting the deal and funding it. And just when you decided, okay, I'm going to start doing this on my own, or the drive there and the path.
Yeah. I don't remember like the light bulb moment of I'm going to buy my first building. But it was basically finished business school, and that was a real grind because I was doing a part-time MBA program which was nights and weekends. I'd been married a couple years, and so newlywed. And then I had also it was 2011 and 12. And so business had picked back up. So I was very busy. And what I like to say is I was juggling a marriage, school, and work. And at any given time, one of them wasn't getting the attention it deserved. Right. So it wasn't fun. And then finally in 2012, I finished school and felt like this huge weight came off my shoulders, and I had all the time in the world. So now I could really focus on business and on my marriage, and it was great. But I still felt like I had extra time and energy. And so I did two big things. Number one, I left. I'd been at a mortgage brokerage shop for 7 years since I left college the first time, and said, okay, well, I'm going to leave that shop and I'm going to start my own mortgage brokerage firm. So really give me flexibility to do exactly the deals that I want to do, focus entirely on Texas multifamily. So that was step one. And then step two, I said, you know what, with my free time, I'm going to start buying some deals. Yeah. And so my wife and I had bought this little piece of land in East Dallas. We bought it for $9 a foot. It was like all the cash we have in the world. We'd put in $50,000 and we sold it for like $120,000. Yeah. And so that was a huge win. So we had a little cash, but not enough to do anything. And so we found an 8-unit property in a good part of Dallas, in the Oak Lawn area. And so we said, okay, well, we don't have enough money to do it, but her mom had a little extra cash and understood the apartment business because her dad, my wife's grandfather, had been in the apartment business. And so we talked about it, the three of us, and decided we're just going to do this together. So my wife and I and my mother-in-law. And so we went and bought it. And my wife and mother-in-law were the construction managers and did the leasing and did it all in the family. And I was in charge of the financing and kind of doing the business plan. And they really did a fantastic job. Certainly, we all made some mistakes in the deal, but did a fantastic job of fixing it up, leasing it up. And we sold it after a 366-day hold and doubled our money and said, all right, I think we got this thing figured out. We're geniuses. And so then we went on and did another one. The next one was 13 units. And then the next one was 65 units and then 116 units. And it just snowballed from there.
Walk me through the metrics on these multifamily deals. And I think I can gather, I've never done one, but we've done single family homes. We've done the vacation rentals is where we're really focused now just because we really like the niche and we know the market, but looked at multifamily and it just seems like it's basically, and I'll characterize it, you tell me where I'm wrong, tell me what I'm missing here, but you get a property, you try to get the right price, you figure out how you can improve it, increase that run rate in terms of the occupancy and the rentals coming in, and then you can then reevaluate that property at a higher value. Is that the simplest way to walk through how it works? Yeah,
real basically, you're right. So we're looking for, in that strategy specifically, we're looking for old beat up buildings in areas that we like, that we can spend a whole lot of money on and make them nicer. And the reason we want them to be in good areas is so that once we fix them up and spend money on them, we can get a higher rent for that nicer building.
Right.
And so what we figured out after we'd done a few is that, hey, these 1960s, 70s, 80s buildings, really, you can't just like paint the walls and put in new light and plumbing fixtures. You really need to go in and fix the HVAC, fix the plumbing inside the walls, fix the foundation and the roof, maybe do new windows and doors, like all the stuff. And if you do all that, you can actually, number one, be proud of it because you've created a new building. But number two, you've decreased the expenses as well. So not only are you getting higher rents and increase the income, but you've also decreased the expenses. And thus increase expenses, decrease expenses, your NOI goes up in two different ways.
Right.
And so that has worked really well for us over the years. And yeah, at the end of the day, you just want your NOI to be a good percentage of your total cost in the deal. That percentage has changed over the years with the market. but that's anywhere from 6.5% to 8.5%, depending on what submarket we're playing in, what the macroeconomic environment looks like, and just kind of keep going.
Yeah. And so most of these, it's basically you build it, you rehab it, which I've seen some of the rehabs or the tear downs and rebuilds that you're doing. And it's pretty extensive. I mean, it looks like on some of these, you're stripping it down to basically the studs and coming back in. Talk to me about some of the challenges there, pitfalls, things that you didn't think about that come up, and just like, it doesn't seem like that would be for the faint of heart from the outside.
Sure. So, and I'll be honest, my job, my wife says I sit in the ivory tower and like all I do is the underwriting, and I put the deal together and I pencil whip the deal. And so, other folks really are in charge of doing the construction and construction management and all that stuff. But yes, I mean, I have to, at a minimum, understand it and the scope of work and the cost and all those things. And we do a lot. There aren't many folks who do the scope of work that we do. But at the end of the day, we enjoy taking projects all the way down to the studs and building them all the way back. And what we end up with is essentially a new building or a new property inside the building envelope of a 1950s, 60s, 70s shell. It really breathes new life into it. It also allows us to charge a premium rent. And so we like to find these older buildings that are in an area where new developments are happening. We charge a rent that's a significant discount to the new stuff, but a significant premium to everything that's old. And we find this little sweet spot in there, and it's worked out really well for us, and not many other people are doing it.
Yeah, no, it's an interesting niche. I've never done a large scale renovation like that. We've had some single family homes where we redid like a bathroom or the kitchen or something like that. Yeah. And it wasn't too bad. It did help with either increasing the rents or increasing the sales price when we went to exit it. But one thing we have done in this recent fund that we did, and we'll get to the QOZ stuff here in a second, is new builds. And I think one of the bigger challenges has been, and everybody knows this with construction, they tell you going in, but you can't really plan for it. It's just like timing on this stuff. It always seems like construction takes longer. Luckily on the cost side, it hasn't been, some of the deals are fixed costs. Some of them are kind of floating, but the cost hasn't really been too crazy in the projects that we built where it's like, oh no, we're going way over. It's been more around timing and just like for example, in the market we're in, I think we've gotten a year's worth of rain, what they typically get annually. We've gotten it during the dry season. So not only did we get the full year worth of rain, but we got it during the time when it's supposed to be dry, and now we're going into the wet season. And so inevitably construction timing it takes a while. But just like, what's the challenge on that? How do you get that down? How do you forecast it? Is it who you're working with? Just talk about timing and things like that.
Yeah. So number one, we've done about 30 of these now. We've learned to essentially budget for everything. So you can't necessarily see everything on a due diligence walk, right? You can't see behind the walls. You can't, especially if it's a slab, you can't see under the foundation. Maybe you can't get attic access, whatever it is. You can't see everything. And so most of the time we're budgeting for absolutely everything to be replaced. Right. And then if we get in there and we don't have to reframe everything, or we don't have to re-level the building, or, something else just doesn't have to be fixed, well, then that's gravy, right? We got a little bit back, but we just assume day one that everything has to be replaced. And obviously learn that lesson the hard way. Yeah. Number two, we say that it's going to take longer than we think it actually will. Learn that lesson the hard way. Number three, we raise more working capital than we think that we need, because sometimes banks take longer to fund draws than they should. And that way we can float between draws, even if the bank doesn't fund quickly. So all those things are just stuff that we've learned the hard way. The other thing that you mentioned just about like weather and timing. Yeah. I mean, all that stuff has happened to us, for sure. I think, permitting in Dallas has been relatively easy, especially on these renovation projects. And so we've been lucky to live and do business in a place that welcomes us, doing business here. So that's been a really good thing, but I know that that's not the case everywhere.
You brought up a lot of really good points. I think the working capital issue is a big one, just kind of budgeting to where you want to have the comfort level that you're not worried about, hey, I got to get this draw coming in. Can I float something? Having maybe a line of credit, even if you don't think you're going to need it. It's just nice to have things like we've learned around there. Budgeting for that extra timing, not just saying it's going to be longer, but hey, what happens if it is longer? Here's how much that's going to cost. I'm trying to think what else. A lot of the stuff you said is really good stuff. And it's stuff that in some way, shape or form, we've kind of experienced just even on different types of projects, right? It all kind of is similar. How did you get into the QOZ side, the opportunity zone side? When did you first discover it? And we'll spend some time there because I know the listeners are probably interested in that. And then how did that evolve for you?
Yeah. So, we started, did our first building in 2012, and obviously that was before opportunity zones existed. But most of the stuff we've done has been in Dallas or in Texas. And for the last decade, Texas has done nothing but go up and to the right. And so as we've been here, our first deals had really good returns. And so we wanted our next deal to have really good returns. And it did. And then the third deal and whatever. But the hard part was on the front end, before we started doing the project, we wanted it to underwrite to have really good returns. And those deals were hard to find, right? Because we didn't underwrite 10 or 15% rent growth. We're underwriting minimal rent growth. And so we really were looking for great deals and we couldn't always find them. And so we looked for new ways to make them underwrite better, to have these cushions that we were used to. And so we learned historic tax credits. Okay, so that gave us a cushion to do a huge renovation deal in East Dallas, and that was great. Well, then we couldn't find any more old buildings in Dallas, so that was kind of short-lived. No more historic tax credit deals. So then we learned a process called fractured condo deconversion. So now we could go buy a project nobody else thought could be apartments, and that gave us a big cushion, and we went and did that deal. That was a big winner, again, in East Dallas. But it's hard to find fractured condo deals. So, all right, no more of those. Well, then we found Opportunity Zone. Our CPA and attorney were early adopters, and we knew this area of Dallas pretty well and found a portfolio of 8 properties, 1960s, that needed to be gut renovated. And we said, well, let's go do those. The OZ benefits give us another cushion, so a little bit of extra juice that make us comfortable to go buy those deals, even though in and of themselves, just on their own, the yield is maybe a little bit too low or right on the edge of wanting to do them solo. With the OZ benefits, you can squint and say, yeah, this makes sense. And so, it's been an evolution to get to OZ, but at the heart of it, we're just Texas apartment guys. And we've just always looked for that little bit of extra juice to make deals work. And that's how we got to OZ. The interesting thing about OZ for us, unlike historic tax credits in Dallas, unlike fractured condo deconversion, is that Opportunity Zone scales. Yeah. And so instantly, instead of being able to do just one deal or 2 deals, now we're on our 23rd Opportunity Zone building. And we have a full pipeline going out for the next year, 18 months. And so that's what's really been neat about OZ for us is it's the first yield enhancement tool that we've been able to find that we can now hit the gas pedal and go.
That's awesome. For the people that don't know, give just kind of your high level on what opportunity zones are, and then we'll dive into some of the details of the nuances with them.
Yeah. So Max, you made a bunch of money this year. Congratulations. You've got a big capital gain. Unfortunately, or you made it last year, right? 2022, you made a whole bunch of money. Unfortunately, now April of 2023, you have an enormous tax bill. If you invest in an opportunity zone fund, then you don't owe your taxes in April of 2023. Instead, you put the money into an OZ fund and you get a deferral of those taxes through April of 2027. So you get a 4-year, in this case, 4-year tax deferral. It's not actually 4 years in the tax code. It's April of 2027. So it's a date on the calendar, not a period of time. And a tax deferral in an inflationary environment is a wonderful thing because Uncle Sam's giving you a long period of time to pay your taxes. An interest-free loan versus borrowing money from the bank at 5, 6, 7%, that's a heck of a deal. But that's not the only OZ tax benefit. That's just the appetizer, not the entree. The really big opportunity zone tax benefit is the second one, which is, hey, you're going to use that money in your OZ fund to invest in something. Whether it's apartments with me or short-term rentals with Max, you're going to invest in something cool. And if you hold that investment for 10 years, then, or 10 years or more, when you sell it, you're not going to owe any capital gains on the new in the opportunity zone investment. Not only that, but you get to take depreciation losses all along the way, and you're not going to have to recapture those depreciation losses. So say Max does a fantastic deal in the OZ structure and gives you a 15, 16, 17% IRR over a 10-year hold period. Well, add in the OZ benefits, and that turns into a 19, 20, 21, 22% IRR over a 20-year hold period, over a 10-year hold period. So it really is accretive to the returns and makes it a heck of a lot of fun to play with.
It's powerful. And what's interesting is that I've talked to a few, not a bunch, but a couple groups that are, larger real estate private equity groups. And I've mentioned QOZ, and they're kind of like, they kind of downplayed it, or maybe they just didn't understand it. They were like, yeah, we looked at that early on and we're not really doing anything there. Why do you think that is? Is it gaining in popularity? It still seems like it's fairly niche, I guess is the first statement I'll make. The second statement I'll make is that some people have said, oh, opportunity zones, that's just, you can't make any money there because it's only in areas where it's low income and there's no opportunity, which I know that's false. That's false. But just, are you seeing the perceptions change? Is it getting more popular? Do people still not fully understand it? What are your thoughts on those?
Yeah, I think it's all the above. I think in general, it's a lack of awareness and education.
Yeah.
I'll say when the first money that we raised for our first OZ portfolio was the hardest money I've ever raised in my career. At that point in time, we had gotten pretty good at raising money from our friends and family and our kind of inner circle. And we could raise, slugs of money pretty easily. But we went to raise $7.5 million. We raised about half of that pretty quickly, and then we hit a brick wall. I mean, I could not get another $100,000 to save my life. And what we realized is like, hey, this OZ stuff is different. You have to educate people. You have to then talk with their CPA and their attorney. You have to really walk them through step by step how this affects them and their tax situation. And you get over the hump on the real estate deal pretty quickly. You can convince them that it's a great real estate deal, but then you have to tell them about this whole other thing. And we got there eventually. It just took a heck of a lot longer than anything else we'd ever done. But once we got over the hill, right, once we reached the top of the steep learning curve, it's been really easy since then, because now everybody in our circle understands it and they like it and they keep going. And so I think now my real goal on Twitter is to just educate like the world, the real estate investing world about OZ and the power of it, because I truly believe that it's the greatest real estate investing structure that exists today, and just want people to know about it.
I mean, for like family office money or money that's more, long-term horizon, that really believes, hey, we're trying to, take this wealth that we have and grow it in the most efficient and tax beneficial way. I mean, to me, this just seems like a home run for that type of money. I mean, it fits other people too, but for a certain type of money that's patient, that really is looking at a generational type of wealth management, man, being able to put something somewhere and have all these benefits, I mean, that's got to be huge for some of these groups. So is it like group specific to certain groups? Like it just clicks and they're like, oh man, that's incredible.
I think so. And when they can say, well, man, I make a bunch of money in oil and gas, or I make a bunch of money from, a dividend portfolio or whatever. And now you're telling me I can get losses and match those up, and you're going to help get rid of income so I think, yes, once the light bulb goes off and they can start doing that in their head, it really works.
What do you think? Talk about some more of the structures, because when we went to be fair, when we went to do ours, part of it was, it seemed to us like it was a really nice option, right? I mean, it was, yes, there was legal dollars up front that we had to spend. We hired the best tax people we knew that specialized in OZs. We, got a law firm that had a bunch of experience, and so it cost money up front for us to get it set up this way. But we just looked at it as, hey, this is a really nice structure. Just regardless, it's kind of like an option. But once you have that set up, what are some of the mechanisms involved? Some of the rules involved, like you have to, enhance the property. You can't sell a property and then distribute that. But just walk through some of the different the rules and structure around it to give people some more clarity about the nuts and bolts.
Yeah, well, and I think I'll just use our deals as an example because we kind of do it in a unique way, but I think it's a good way. So every project that we do is owned by an LLC called a Qualified Opportunity Zone Business. And the Qualified Opportunity Zone business structure is interesting because the QOZB can take money from anybody, whether or not they've had a capital gain. And I think that that's important to say because we want these deals to be good enough for anyone to think it's a good investment, right, whether or not they get the OZ tax benefit. And so ideally, someone should be willing to jump in and say, that's a great deal. I want to write a check whether or not I get the OZ tax benefit. So that's number one. Anyone can invest. But if you want the tax benefit of the opportunity zone, then we can give it to an investor in multiple different ways. Number one, we might set up an opportunity zone fund just for that deal, and investors could come into that deal specific opportunity zone fund. Number two, your family or family office or your golf buddies might set up an OZ fund together. And that OZ fund could come invest in the QOZB. Number three, there might be an institutional fund, and they might come invest into our QOZB. So there's really four different ways that we've seen people invest into our deals. Number one, with non-tax advantaged money. Number two, into a QOZB that is just investing in this deal. Number three, with what we call a captive OZ fund, so something that they own and control, but they choose to invest in our deal. And number four, like an institutional OZ fund.
And so once it's in, what are the different rules and requirements once the fund is up and going to meet the requirements to get the benefits from the tax side?
Yeah, so different requirements for me as the opportunity zone business operator versus them as the fund operator or me as the fund operator, depending on where the investment happens. At the QOZB level, which is the owner of the real estate, I've got to do, I need to own or operate real estate that fits into three buckets, either ground up development, I need to substantially renovate a building, or I need to buy a building that's been vacant for 3 or more years. So those are kind of the rules at the property level. And if I do new development or substantial renovation, I have 31 months to do that. But those are the basic rules at the real estate level. At the fund level, my main rule is to put all my money out and not have a bunch of cash sitting around. And I'm tested on that every June 30th and December 31st. And I have to have less than 10% of my fund in cash. on those dates.
Okay, that's interesting. So how does that work with like working capital and things like that? What if you need a cushion during when those dates are coming up? Do you have a line of credit you can pull? I mean, what are some of the mechanisms you do to manage that portion of it? Just because, being 90% invested is good because you're trying to deploy the capital and put it to work. But at the same time, like all the things we talked about earlier around working capital management, the way that you manage the business, does that ever rub against the requirements for the QOZ?
Yeah, so that test is at the Opportunity Zone fund level. And we think of the fund as truly like a pass-through entity. So the cash goes to the fund for a very short period of time and never on June 30th or December 31st. And then it just goes straight to the Opportunity Zone business. And the business is the real estate development entity.
Gotcha.
And for the first 31 months, which is that development period, you have a safe harbor where the amount of cash that's held at the QOZB level really isn't important. So it's tested. The QOZB is allowed to have up to 30% of its assets in cash. But for the first 31 months, that test doesn't matter. And so during the development period, you can have a bunch of working capital and that's okay.
Yep.
And so that's it. But then once you're done building the deal and you're stabilized, you just need to make sure that you don't leave a bunch of cash sitting around.
Sure. Yeah, that makes sense. That's a good way to put it. The options for the investors to get the money returned to them. I think you mentioned earlier, but it's a 10-year period to get the tax benefits. And then there's other mechanisms along the way to make distributions. Why don't you talk about how that works, what you can and what you can't do, and what are some of the options?
Sure. Maybe ask that specifically. I think in general, we think of these deals just like normal real estate deals, but you can't sell the asset for 10 years. And so we're going to, for a development or big value add renovation, we're going to do that. We're going to build it. We're going to stabilize it. We're going to refinance it, send as much money from the QOZB to the QOF as possible. And then we're going to cash flow it through at least 10 years and then sell it. So it's more or less like a normal real estate deal, except that sale date will not be for 10 years. So our goal, though, is to refinance it and send cash back to investors as quickly as possible.
But can you recycle properties within the fund and then 1099 those into another one? Or how does that work?
Absolutely. So say that you set up your own OZ fund, and as part of that, you invest in one of our apartment projects, and that's a QOZB. Well, I build something, then we stabilize it, we refinance it, and I send back a bunch of money, right? And now all of a sudden, your fund has a bunch of money again. Well, at that point, you have some decisions to make. They're good, high-class decisions.
Yeah.
But you can either send the money back to your personal checking account, and that's great. Refinance proceeds are not taxable. So you would get that money back, and it wouldn't be a taxable event. It also would not trigger any taxable events with your OZ fund. So just by sending it to yourself, it's not like all of a sudden you owe your taxes from your capital gain event that you funded your OZ fund with either. You still have till 2027 to pay those taxes. However, you have another option other than sending the money back to yourself from your OZ fund. Your other option is, hey, I'm going to invest in another OZ deal. So now maybe Max, your group has a new short-term rental deal or a new cabin rental coming up in Broken Bow. Well, you can take the money that's in your OZ fund and you can invest into another qualified opportunity zone business that's doing a short-term rental project in Broken Bow. And all of a sudden, you're doing a second OZ deal with the same OZ fund. Right. And with that deal, you're creating more depreciation that never has to be recaptured. And you're building another project that you're never going to have to pay capital gains on once it's sold. The other beautiful part about it is your 10-year clock that your 10-year required holding period doesn't restart at the second deal. The 10-year clock started the day you put money into your fund, which might have been years prior.
Yeah, that's huge. What about like with, what if you had to, you've talked about the refinancing, and this is just me asking questions. I'm getting kind of in the weeds, but what if you had a property that you renovated, you stabilized it, you got an offer that was just so good that you're like, man, could you sell the property? But then as long as you hold it within the fund, you're then rolling it into new properties in a 1099, and then that doesn't trigger the sale, or is any sale at all? Just walk me through how some of that.
So way into the weeds, and now I'll give the caveat I should have given earlier, which is I'm not an attorney. I'm not a CPA, and yeah, call those guys when you get to this level.
It's complicated, but I just like hearing your take. And again, this isn't investment advice. It's not. This is you guys talking about it, but this is me being curious because you think about all these little weird nuances of the different scenarios that could play out.
So here's my understanding after talking with some guys who really get this stuff. I think your best option, if this were to happen, is to do a 1031 exchange.
Right.
And so you would actually just do a 1031 exchange into another property. The problem is that 1031 exchanges in the OZ structure are hard because you're likely going to have to do a 1031 exchange into a construction project. And that's really difficult. So that's number one. Number two, you could sell it and then you would have a capital gain. Well, good thing you already understand the OZ structure, because you could take the capital gain, distribute the gain out of the OZ fund, and create a second OZ fund to deal with the gain.
Right.
Is that crazy?
Yeah, enough? I know. No, it makes sense. It's just interesting because I think these are the types of questions that people, the main things that we were getting asked questions around, and we did refer people to our tax, specialists and our attorneys, but it's like really around the liquidity. How can we get money out? Does it have to be in there for 10 years? Are there ways to make distributions? And so we're trying to, talk through all this stuff. And again, I'm kind of like pushing it to the experts during those conversations, and it's complicated. But one of the things is like, around income, right? You can still distribute income. It's just the sale. So that was one thing that people were really hung up on. It's like, no, well, if the property's generating income, those distributions are allowed.
Yeah, you're fine there. But I mean, this is a misconception, but if you sell something prior to 10 years, that is a taxable event, period. Right. Yeah.
Yep. Talk about just more around managing as a GP or raising money, just the challenges there, the rules that you live by, the things that you think about when you go to raise the money, the type of LPs that you target, and there's all kinds of things around raising and managing money that sound glamorous maybe from the outside looking in, but when you start to do it, it's harder, and you gain a level of responsibility it's a very high bar.
Yeah. I don't know that there's one specific thing to say. It's been, for us, very organic growth over the last 10 years. So it's like, I mentioned the first like LP check was my mother-in-law. Right. And then the second deal was my mother-in-law and my parents. So it's very slowly we grew. And then we've grown a lot faster over the last few years by necessity as we found more and as we found more good deals. So how do you talk to people about it, or who do you target? I'm not sure I know the answer. But how do we find those folks? It's almost predominantly just by talking to the people already in our network, and saying, hey, if you like what we're up to, if you wouldn't mind sharing with me a few people who you think we should be talking to, that would be wonderful. I would say those are always the most productive and fruitful meetings for us.
It's like all business. I mean, you're basically describing like what we do on the service business that we have. It's like the cold call stuff and the outreach stuff is what I found in general is that like, even in our energy services businesses, it's probably like 10 to 15% of all business we've got is just from like random cold call or random outreach. It's like 80 to 85% is relationship based, network based. And that's really important. What about like just managing LPs, like the amount of time you have to spend communicating? How important is that communication? Just things, the way you think about all that stuff.
Sure. So my business partner, Seth, and I have now been doing deals together for about 6 years. When we first started, I was still doing mortgage brokerage. He's built a property management company to 20,000 units under management.
Wow.
We're both like busy, right? We were doing a bunch of stuff. And so when we were buying deals, it was very much like a second job, which I don't know that we gave it we took it very seriously, but it wasn't a company for sure. We just would find a good deal. We would do an operating agreement. We would get some investment. We would go do that deal. And that has changed a heck of a lot over the last 18 months to where, hey, now we have a company that is managing investments for a lot of people, some of whom we've, not known that long. And so it is a much higher bar for how we treat these folks. Right. On a deal 5 years ago, I would have had 8 investors who I could send a text on a chain to and say, here's what's up. Call me if you have questions.
Yeah.
Now there's 40 investors. It's a different thing. And so what have we done differently? Well, we've moved everything, including every deal we've done back to 2012 over to Juniper Square, even the closed deals. So now all that tax stuff, just everything is on Juniper in one database. Somebody's joined us who has a very institutional background. He was running like part of the real estate pension funds for state of Florida. And so he knows how to do very extensive reporting, and he's joined us and put in a whole bunch of policies and procedures and quarterly reporting and all that stuff. So now we're starting to implement that kind of thing. Doing the equity books, doing the debt books, like all of that's being formalized, either has been or is being formalized. But yeah, it's a much higher bar as you grow. And you just have to get comfortable with, like, if I want to be better and if I want to grow, I need to be better at X, Y, and Z. And so you have to understand the deliverables that go into that.
That's really good. We're getting close to an hour here. I want to be respectful of your time, but Danny, I think you kind of led into it with Juniper Square. I'm not super familiar. I know a little bit, but one question I was going to ask you is, what tech do you guys use in your operations that helps you guys out?
Yeah, so we use, just like every day in the deal side, we're using like Google Earth Pro, Axiometrics, CoStar. We're using Microsoft Teams, the whole suite of that. So some pretty basic stuff. The big fancy ones that we're now using is Juniper, and we're about to implement. And then we use one called Loan Boss to manage all of our debt. And we're about to move over to one called DealPath, which will be a deal management software. So those are kind of the 3 big fancy ones that actually cost real money. But all of them, the whole team is using them pretty effectively at this point. And we wouldn't have dreamt of using those, 2 years ago.
Yeah. It's just nice. When you discover these different pieces of tech, sometimes it can seem like a big cost, but it can make your life easier. Last question here. What do you think about just Texas in general, the real estate market? I know that's a broad question, but to me, it's like even what we're doing, I know it's Southeast Oklahoma, we're getting the Texas effect, which is, I say everything's bigger in Texas, but is it still a great place to play from the outside looking in and from the market we're in? It seems great, but just your thoughts on Dallas specifically and kind of the Texas market.
Yeah, well, and I think it's all Texas markets, just continue to grow. There's job growth, there's population growth, there's, everything continues to happen so well. And the quote that I've shared before, but it was recently in the Dallas Morning News from a big economist named Mark Dotsor, but he said, look, the recession is here, but Texas has decided not to participate.
Yeah.
and I think that, I mean, as far as I can tell, it seems pretty darn true. It's pretty full employment. Every restaurant's full. Rents seem to be growing. Leasing has had a very slight pause in the fourth quarter, but has already picked up at the beginning of the year. Things are just rolling pretty well. Now, does that change? I don't know, but it sure doesn't seem, like we're in a recession today.
Yeah, it seems like it's even in our market. I think there was a shock with rates going up as quickly as they did, at least from like the transaction. You start seeing stuff stay on market longer. But even just like anecdotally the last month and going into this month, talking to our friends and real estate agents and other developers, stuff's still transacting. And it's transacting at a decent price. And the thing that's been really encouraging for us is like the demand seems really high still for at least what we do. There's a lot of inquiry, a lot of interest in it. It's just people are more cautious. People are freaked out by the rates jumping up. But I've got a buddy who's an investor in some of the stuff we do, and he's about 6 or 7 years older than me. And he's like, man, when I got out of college, he's like, it was like 6% to get a mortgage. He's like, this isn't that weird. He's like, I think people just got shocked by that, like the whipsaw of how low, just how quick it went up. It just seems like things will normalize. And I do feel like this part of the country in particular, I'll lump Texas and Oklahoma, and I know it's not the same, but we kind of get the benefit. You get a lot of those benefits just being in such close proximity. It seems like things are relatively healthy, given the state of where you hear about some of these other markets, at least.
Yeah.
Well, Barrett, thank you for coming on. I really appreciate it. I appreciate all the advice you've given me on and offline, and best of luck to what you guys are doing. And I hope to continue to watch your success on Twitter and on social media.
Thanks so much, Max.